Which mutual fund is the best for me is the age-old question that plagues many investors. But don't worry. If you understand the various types of mutual funds, you can choose the right one for yourself. Hello everyone. Welcome to our channel 5 Minute Finance. Today's video is going to explain different types of equity mutual funds. These funds can help you fulfill your long-term goals, which are at least 7 years away. We'll look at their performance and how these funds are different from each other. So watch this video till the end to be in a better position to select the best mutual funds to satiate your financial appetite. There are 37 mutual fund categories. Yes, a whopping 37 categories, out of which 11 are equity funds. So let's look at the different types of equity funds one by one. But before that, you need to know the meaning of market capitalization, often called market cap. Once you get this concept, understanding equity funds would be a cakewalk. So, the market cap of a company tells us how big or small a company is. Like Reliance, Tata Motors are large companies as they have huge market caps. Now, understand it like this. Suppose I calculate the market cap of all the companies on the stock exchange and sort them from the largest to smallest. Now, the top 100 companies are called the large cap companies. Companies ranked 101 to 250 are called mid cap companies. And companies ranked 251 and onwards are called small cap companies. Moving back to the equity funds, we'll start with the easy ones. So large cap funds, mid cap funds, small cap funds and large and mid cap funds. So large cap funds are the ones which invest at least 80% of their portfolio in large cap companies. Similarly, mid cap funds invest minimum 65% in mid cap companies and small cap funds invest minimum 65% of their portfolio in small cap companies. Now, since large cap funds invest in the biggest companies that are already established, they are considered as less risky than mid-cap and small-cap funds. Moving to the most favorite part, their returns. Large-cap funds have given an average of 13% returns in the last 10 years. Mid-caps have given 18% and small-caps the highest 20%. Did you notice something? The riskier the fund, higher the returns. But that shouldn't be your deciding factor. You should invest as per your risk tolerance and the time to achieve a specific goal. Then we have large and mid-cap funds. Now, these funds invest at least 35% each in large cap and mid cap stocks. Generally, they are considered riskier than pure large cap funds and less riskier than mid cap funds. In the last 10 years, they have given an average return of 15%. Now, let's move on to the highly versatile equity fund categories which invest in companies across all market caps. So, flexi-cap funds, multi-cap funds, ELSS, focused funds and dividend yield funds fall in this list. Let's see where these funds invest and how they are different from each other. We'll start with flexi-cap funds. These funds are like a chameleon. Like chameleon blends with its surroundings, flexi-cap fund can change how they invest in large, mid or small cap companies based on the market conditions. They have to have at least 65% in equities. Then comes multi-cap funds. These funds also invest across market caps, but they have to follow some rules. They must have at least 25% each in large cap, mid cap and small cap stocks. The remaining 25% can be either in equities across market caps or in debt instruments. Next are well-known tax-saving funds called equity-linked savings schemes, ELSS funds. They are popular as they help you to save taxes under the old tax regime. Now, they also invest like a flexi-cap fund, but they come with tax benefit and 3-year lock-in. Next are focused funds. Now, they also invest across all market caps, but with one condition. They cannot have more than 30 stocks in their portfolio. In comparison, most mutual fund schemes typically hold around 50 to 60 stocks. Then we have dividend yield funds. Now, what is a dividend? So, when a company makes profits which it wants to distribute to investors, that is what we call a dividend. These funds also invest across market caps, but in companies which pay regular dividends. Now, all these funds have given returns of around 15% in the last 10 years. Moving to the next set of funds, value funds and contra funds. Now, as a rule, mutual fund company can either offer a value fund or a contra fund. Both these categories look for stocks which are either mispriced or undervalued, with a belief that stock prices will rebound in future, giving gains to investors. But there's a difference. So while value funds invest in companies whose stock prices are considered lower than their actual worth, which we call as undervalued stocks, contra funds invest in stocks that are out of flavor or experiencing a temporary setback. Both these funds have delivered returns of around 16% on an average in the last 10 years. The last category in the list of equity funds are sectoral or thematic funds. They invest a minimum 80% in a particular theme or a sector. For instance, if you look at the portfolio of ICICI Pru Banking and Financial Services Fund, you'll see it is invested mainly in bank stocks, other financial stocks, and insurance companies. Sectoral or thematic funds are very risky for retail investors because their fortunes depend on the performance of a particular sector. That wraps up this video. Hope this helps you pick the right fund for your long-term goals. If you found this useful, please share it with your friends as well. If you have any questions, feel free to ask in the comment section below.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.